The old school real estate mentality was real estate's very local. You're supposed to know the properties where they are. You know the sponsors, how they are. All that is great and phenomenal, and it makes our job better. It makes investors more accurate, etc. We can do stuff that your XYZ bank can't do because they just have a policy that says no. Yeah. The other thing everybody forgets that even very sophisticated investors forget is that a refinance in 3 years is not free. The uglier and dirtier, the better, in my opinion, because that kind of irreplaceable real estate, or the tenants that, just really need to live somewhere or really need to have their business in a location, that's the kind of real estate that I just love.
Welcome to the CashFlow Quest. We got a good friend and guest, Cody, and I didn't want to slaughter your last name. How do you say it?
Charfauros. It's been my whole life. Sorry, don't feel bad.
Cody Charfauros. And we welcome. We're stoked to have you. We're really excited to hear your story. Obviously, also a Christian believer friend of mine, does a lot of stuff in business ministry, bringing guys together. So I've always appreciated and respected that.
Well, I don't know your background story. So if you could tell me what Blake knows, fill me in on kind of how do you guys know each other?
Sure. Yeah. Well, I grew up in Southern California, working class family, very working class. Okay. Not far from here, actually. And I originally was going to study to be, well, first I wanted to fly. I wanted to be so we have a little bit in common there.
Yeah.
I wanted to be a naval aviator.
Okay.
That was my original plan. And part of that, I was going to go to the Navy. And so I kind of scheduled everything in my life to be around that. I wanted to be a naval officer, et cetera, et cetera. So I did the Boy Scouts because I wanted to be an Eagle Scout. I was planning on going to the Naval Academy, or if I didn't get in, regular college, so that I could be another level up as an officer.
Okay.
With the whole goal to fly. That was my whole thing. And I had a mentor early on that was a naval aviator. And so I wanted to walk in his footsteps. One of the reasons why I decided to not join the military. Well, first, I realized my eyes were not good enough to be a pilot at the time. Now LASIK is okay, but it wasn't at the time.
Yeah.
But secondly, I met my wife in high school. We were high school sweethearts. We started dating, and I pretty quickly realized she probably doesn't have what it takes to be a military wife. So anyway, I pivoted then and I was going to be an engineer, took 1 year off of math and realized, well, this is kind of nice to not have to do math for a minute. Took a year off because I was about to jump into crazy high level math.
Okay. Doing what?
I was going to be a mechanical engineer, aeronautical engineering specifically.
Okay, so you were still in the aeronautical realm.
Yeah.
Not
I can't fly, I'll build airplanes. Sure. That was the idea.
Okay, well, that's a pivot. Yeah.
Yeah, so then I took the year off. I'm like, this is kind of nice. Maybe I'll just be in the arts. So I pivoted hard.
Yeah.
And started doing business and film. Okay. So I went to USC for business and film. Primarily film, a little bit of business.
Great school.
Yeah.
Love the Trojans.
Yeah. Fight on.
Yes.
And we, and then I was in the film industry for over a decade, and then tiptoed my way into commercial real estate.
So yeah, that's a pivot. How did you pivot then from the film industry into real estate? That's kind of different.
Yeah. Well, I was in the film industry for, like I said, over a decade, primarily visual effects in the end. Okay. And I was working on really cool movies, dark rooms with interesting people, the whole nine. But I got really burned out. It was a really tough business. I would constantly be working 85, 100 hours a week.
Wow. So did you do any that we would maybe know? Yeah.
I mean, I worked on second Iron Man, the third Iron Man. Oh. If it was a Marvel, I had a hand in it for that period, and then a bunch of others.
Wow.
So it was fun. Yeah. It was really cool to be a part of that.
And learn that scene and how that all works. And
absolutely.
The LA kind of vibe with that.
Totally.
Yeah.
The thing that broke the camel's back for me was I had a young son, my first. Our condo was being fumigated. And so I handed the keys to my neighbor. And I said, when the fumigation's done, please lock everything out. I'm going to be at the studio because I'm delivering a movie. I'm not going to be here anyway. It's kind of perfect timing.
Yeah.
Well, turns out I had to deliver this movie, and we were delayed in the delivery by over a week. So I slept on the floor of my studio, took all the meals, showers, etc. there. Then went home after a week being late, and I walk in, and all of my windows are open. My garage door is still open. My front door is wide open for over a week. It was like 8 days that it was like this. And I went to my neighbor, and they said, oh, yeah, sorry, I forgot. And I said, this is not only impacting my home life, it's literally impacting my house. And my best friend, roommate at USC, he had a similar story where he was in marketing. He got really kind of burned out too, but he ended up leaving and looking around and said, Dad, why are we wealthy? And he said, well, we're commercial real estate investors. This is our business. Yeah. So he started to learn the business. He ended up joining our firm as an analyst. And then I said, hey, I would like to do something different. What do you think? And he introduced me to their firm, to the guys in LA. And they said, well, we don't know what to do with somebody that has a background in film, but we really like you. We'll see how this goes. And then they offered me a position. So I just started. Now it's been 12 years.
Okay. Same group. Same group. Slatt Capital. Cool. Slatt Capital. Which has always been focused on commercial real estate loan originations? Yeah.
Primarily, our focus is private client loan originations. So these are sub-institutional, all asset classes. We have to be generalists because our investors are generalists.
Interesting. Okay. So is it short-term, long-term?
We specialize with our correspondents on the longer term. Mm-hmm. So the correspondent lenders that we represent are primarily life insurance companies. And because of that, they think about things on a long-term basis. So where most commercial real estate loans might be 5, 7, or 10 years in duration. Ours go all the way through 30 years.
Okay.
And for all asset classes. And so our firm has always been known as a kind of a small loan firm. We do a lot of smaller widgets, but we do a high touch service for all of them. And so I'm 12 years in, so I kind of know what I'm doing now, but I don't know outside of that, except for as a side investor, what the commercial real estate space is, because I've really been narrowly focused in that private client, smaller downward space.
What's your typical loan amount? Yeah, roughly.
My average is about $4 million.
Okay.
The firm's average is like 5.5, so I'm a little bit on the lower side of that. But this biggest loan I've done personally, single property transaction, was $35 million.
Okay.
And mostly they're in that 2, 3, 5, 7, $10 million range.
On the underwriting side, do you guys do it all?
We have our own underwriters in-house. We also have our own closing team and our own servicing team. So we can play both sides. We're a broker and we're also a correspondent direct lender. On the correspondent side, with our 25 or 30, depending on the market, we represent more or less those lenders. They actually go onto our books. And so those loans are serviced for us, with us in perpetuity. So they'll be with us 30 years.
So that's a nice little side piece of that business then.
It is.
Because that's a subscription portion of the little fee generation.
Yeah, and it's important too. I mean, this was something I sold for a lot of years, but didn't experience it, which is the high touch service post-closing.
Oh.
And it's something that I talked about, but I didn't actually know what it meant, or I couldn't speak to it. But then COVID happened. I actually saw it. So for example, when all of the shutdowns were happening, we have a lot of retail in our portfolio. Multi-tenant retail was not doing well in the early days of COVID. Everything was shut down. Tenants were wondering, can I operate? When am I going to be able to operate? And our clients came to us and said, we don't know if we could make our payments. Well, I actually had hand in reviewing those requests, and I could approve them really quickly. If you contrast that with, say, a bank that was doing the same thing at that time, I had clients in mid to late 2022. So now this is at least, depending on how you measure it, 8 to 9 to 12 months out from the shutdowns, that were still asking for relief from some of these banks. And we granted relief in 90 days. It was just like, yes. And then we'll figure it out in another 90 days. So that kind of high touch service, or if we had to replace a tenant and we needed to approve, a new lease, we could do it ourselves instead of have to jump it into some random place in the middle of the country that doesn't know the sponsor, doesn't know the property, doesn't know their background and all of that. We could just trust and make sure that it's going to happen. So that kind of thing I was selling, but didn't understand. Now I understand it.
So let's say you have a building, you want to borrow $5 million, $10 million building. You want to borrow a 50% loan to value, $5 million. Who's your standard lender for, let's just say, a multifamily asset?
Sure. Yeah. I mean, could be an agency, for example. And in fact, what we do, part of our service is that we shop all of the sources. And so we truly have the full market, right? A lot of people say they have the full market, but they actually don't.
So then does it matter in your kind of COVID comment about being the servicer? Does it matter who originated the paper on if you could go back and negotiate the note on their behalf? Because that's saying something,
Yeah.
right?
Yeah, absolutely. It does matter.
So
anytime there's any kind of a relief, then we are ultimately the ones that have to make that call. We will approve it or not approve it.
Mhm.
And we'll approve it. And so sometimes we had to have intimate conversations with our clients that said, yeah, we understand that you're suffering at this property, but we also understand the other 20 properties that you have are doing just fine. Just know that we have a very long-term memory. So look really hard if you really do need to skip this payment, because we'll keep remembering that, right? It's a little bit of old school give and take. That doesn't mean that we just, fall down on every single request, but we look at the whole thing holistically and help them make the right decision, because everybody has a very long-term memory. And if you're truly in trouble, we'll give you some relief. But if you're not, then let's be honest with each other.
So you would go back, let's say they retail asset, took it right on the chin. They really were down on income. They couldn't make the payment. You would, on their behalf, go negotiate the deal with the lender.
In some cases, depending on the deal, we don't have to negotiate anything. We just look at the situation and say, yes, you're good. Don't pay us for 90 days.
Oh.
Because we're handling it.
That's amazing, though.
Yeah, we're essentially the lender.
Autonomy, though. That's pretty cool.
Yeah. And there's more nuanced scenarios where it's not just
like the
actual goes away.
The agencies probably, could you do that? Or not?
Less with the agencies.
Yeah. Okay. So then CMBS probably.
Yeah. Life goes, we have more discretion.
Yes.
If we're cashiering, we have even more discretion.
Okay.
If the payment is actually coming through us, we can do certain things that. Yeah.
So then that's in your kind of contracts and relationships with these various lenders.
Right.
Interesting.
Exactly.
Yeah.
Yeah.
Okay.
And the old school mentality, it used to be before you could go onto Google Earth and look at an aerial and a property.
Before you could get, a nationwide CoStar license to get a sense of what's going on. The old school real estate mentality was real estate's very local. You're supposed to know the properties where they are. They're the kind of, the sponsors, how they are. And so you can vouch for them. That's the mentality that we carry into this new realm. So we have more data now. We have more, all that is great and phenomenal, and it makes our job better, right? It makes investors more accurate, et cetera. But also we can vouch. We can say this person has done right by all of our other lenders for the last 15 years. They truly are distressed. Yeah. And we can say, yes, you're the right kind of person that will take the flyer on for this deal. And so it's kind of a hybrid mentality.
Yeah. You're kind of like risk assessment with your clients of is this person really good or, higher risk of potentially having issues. Yeah.
And we also know, the market's down right now, but this market has a history of being really great because we're experts in this market. We're going to be just fine. So,
that's cool. That's cool optics and a cool servicing kind of, white glove service that you can bring to higher net worth kind of.
And sometimes it's even more subtle than, a whole property is doing really poorly, but maybe it's, there's a environmental issue on a property and we need to be able to sort of work through that and have a full understanding, nuanced understanding of that issue. We can do stuff that your XYZ bank can't do because they just have a policy that says, nope. But we can look at a situation. And so that this makes sense for X, Y, and Z. We'll do that deal where lots of other people won't.
Be a little more nimble with certain situations.
Right.
So we talked a little bit right before coming into here that there's a market's interesting right now. Treasuries are down. Rates are kind of decent. Today's, what is Trump calling today?
I forget.
Anyways,
whatever. Someday,
it's
right?
April 2nd, and all the tariffs go into play.
Yes.
Yeah, exactly.
Yeah.
And
But
he had some
Day of Freedom or something.
Yeah. He didn't want to do it yesterday in hopes of, no April Foolsing anybody.
So just interesting, especially, being in that we're constantly borrowing on the multifamily mobile home park side. We see rates, treasuries, all of our rates typically are based on the 10-year treasury. So what are you seeing in the market? And you mentioned that there's some kind of interesting kind of chess or cards being played on borrowers right now.
For sure. Yeah. I mean, so from the 10,000 foot level, rates are very low on the spread basis right now. As you know, treasuries have been high and they still are high, even though they have come down in the last couple of days, last couple of weeks. We think that there's a window going on right now where the spreads are kind of at the bottom of where they could possibly be. There's a couple of reasons for that, which I can get into.
That product specific?
It is product specific,
what's
but generally speaking, everything is lower relatively than they have been.
Yeah, I agree with that. You know, what product is like the sizing great right now? If you were listening to this and you wanted to refinance something.
Yeah. Anything multifamily, including MHPs, is in that category for sure. And then industrial. Those are the two that
the lenders are loving.
Lenders are loving it and they want more of it. And they're doing everything they can to make that. Yeah. And so some of what I was telling you before, that we have a couple of quotes in those two categories that are below 100 spread, which is just ridiculous.
We locked in our current loan that we're going to close in end of April or May 1st at like 97 bips.
Mm-hmm.
Yeah. Historically, we're 150 plus.
Yeah.
You know, we did a buy down, we did this and that just to lock that in.
For sure. Yeah.
But it's under 100 bips. I mean, that's insane. And then it traded cheaper. So that's how we got under 100, basically like 102 or 3.
Right.
And then it traded at 97.
And I think what's happening with the agencies and a few other capital sources is there's two things. One is a capacity. They've got a lot of allocation of money they want to get out, and there's a lot fewer transactions.
Yeah.
So they're trying to buy
early in the year.
It's early in the year, and we do think that later in the year these spreads are not going to hold. Mm-hmm. So that's number one. But number two, on a global basis, you know, these are finance companies at the end of the day, and they're looking at alternative investments just like anybody else. So they're looking at stocks, they're looking at bonds, what's happening with treasuries. We're looking at corporate bonds. And one thing we track all the time is the Moody's corporately backed BBB and above corporate bonds. And those are at 30-year lows right now. So if
30-year lows on their payout
on the spread over treasuries.
Okay.
Yeah. So the spread, you know, treasury being a risk-free rate, and then the spread over that for, say, lending to Apple.
A premium.
Yeah.
For holding a business bond.
Exactly.
Okay.
Yeah. So the bond, the premium is very low on a 30-year average basis. Very, very low.
You might as well take a U.S. Treasury.
Right.
Yeah, exactly. Yeah. And so for that reason, they look at it like, I'm going to lend on commercial real estate, or I'll, you know, take a treasury, or I'll lend to Apple or PepsiCo, right? A credit tenant or credit rated bond. And these are aspects that are competing with one another. And because they're all competing and they're all very low, the spreads in the commercial real estate space are also low. But it's for a time. How long is that going to be? And we do believe that treasuries are artificially high, and they at least on the shorter end of the treasury curve, they have room still to run. But the question's going to be, if they go down, do the spreads hold, right? Mm-hmm. Or the spreads have room to increase?
Right.
Yeah. So then your all-in functional interest rate could go up. Exactly.
Yeah. Best case scenario is you break even from where they are right now, but they could go up.
That's a new dynamic on the whole pricing dynamic.
Yeah.
Of what is your interest rate going to be on a given asset? Yeah.
Yeah, because they could hold if your spread goes back from 1 to 1.5, and the rates go there's what's going to happen.
Net your all-in rate is the same,
or it could be higher.
It could be higher.
If
we had to go back to 150 bips,
right? We would have.
But let's say treasuries only went to like 4, we'd be 25 bips higher.
Right.
You know, it's like, dang.
I know.
Well, that's not good.
No.
You know, so yeah.
The other thing everybody forgets, that sponsors, even very sophisticated investors, forget, is that if a refinance in 3 years is not free.
No.
Yeah, it costs money to do that.
We learned our lesson. We took a couple, 3 exactly, Freddie floaters at like the bottom. And it was like, we were dancing, having a good old time.
It was amazing.
Like
2.3%
interest only.
Yeah.
You know? And then, you know, afterburners hit 2021, 2022, and we rode the wave. We were buying, we were selling. I had to pivot and like do some of the hardest selling I've ever done, and convert 2 sellers to seller carry real time in escrow because rates were just blowing out the deal. Basically, I was going to have to walk we weren't going to necessarily lose earnest money or anything, but it was just like, I'll never forget that moment.
Yeah.
of the floaters.
Well, it's good that you recognized it early, because a lot of people, they didn't, or they recognized it way too late.
Well, and we already had a few floaters that were originated. So we were along the ride for those.
Yeah.
And it was, and basically our business model, let's say it was a $5 or $6 million mobile home parks, and just happened to be kind of in that price range, 3 different assets. And we had $500,000 million in operational cash that we were going to use to execute. We didn't need a ton. It was just this or that, we had to fix up. Well, then rates started going. They just pulled all of our money, cleaned, took all our bank balances and impounded the money for the next rate cap purchases that we may or may not be making, depending, but they didn't care.
Yeah.
And one of a legacy move my dad and I made, and I'll give the credit to dad, was we're just kind of getting comfortable with these floaters because it's like unbelievable cheap money.
Yeah.
But he goes, you know what? Let's buy an extra year. How much of rate cap? And so we ended up buying a 3rd year. And my mortgage broker was like, nobody does this, man.
Yeah.
And I'm like, well, how much is it? And it was like $7,000 for the extra year. And I'm like, I know, but these are value add and I don't want to be in a pickle. If rates go up, I would like an extra year to be able to refi. Anyways,
very wise.
My dad's sage advice. I mean, now in hindsight, I would have bought the whole freaking loan term and I would have made millions of dollars on the caps.
Right.
Yeah.
But we at least had a 3rd year.
Yeah.
So we operate, we get through the second year. We're not, and basically every time we size, we're like at break even. And everyone's guidance was, well, why don't you hold? You have another year of rate caps. And we just kept sizing and rates just kept going up. So every time we'd like make up a couple $100,000,
worse and worse and worse.
It just kept moving. The needle kept swinging and proceeds kept basically coming down or staying the same.
Yeah. And then we were starting to get close to that 3rd-year deadline. So we're like, just make a move.
Well, so we basically took all 3 of our loans through the 3rd year and exited them all with like a month or 2 left.
Amazing.
And we made like 30 or 40 grand on the month.
Rate cap. So a sale.
Just to like when we paid off those loans and we had like 30 or 60 days left on the rate caps, somebody was buying them.
People were still just reaching for time, reaching for just like something to like anything to help
I'll never
me.
Forget that whole dynamic. Meanwhile, we're locking in some seller finance deals all in the mix, at the same time.
Yeah.
And so that's a long way of saying we've decided to go like super low key conservative, fixed rate, focus on day one cash flow from a resiliency.
That's really smart. Yeah.
So we're doing a lot of 10-year Fannie Mae product right now at 100 bips over 10-year IO fixed because leverage is sizing low anyways. Right. So we're taking moderate leverage, full term IO. Set it and forget it. 55% loan values, and we're like, to heck with it.
Yeah.
Absolutely.
Let's be safer. Even if it's like, well, gosh, guys, couldn't you borrow more money? It's like, well, we could borrow maybe a little bit more. But if you're investing in the deal, wouldn't you be happier with like a little less risk? We're not going to be hindered by the volatility.
Yeah. And the IO is good too, because your all in loan constant is it's the same as it would be if you were at a 30-year amortization at a lower rate. Right. So you're actually engineering the same return that you would ultimately, which is great.
The pay down's minimal. Most of our deals in the day were half term IO, 5 years IO, 5 years 30.
Sure.
And the pay down's pretty small.
Almost
so
nothing.
It's like, what are we worried about this for then? Let's just raise a little bit more money, be a little bit more padded. And then our cash flow plan is simplified.
Mm-hmm. Right.
So
to your point about long-term fixed, the best deal I did was a 20-year fixed, 30-year term. It was a single tenant commercial real estate property, retail, with 3 years of interest only. And we rate locked, and it's still to this day, 278 interest rate fixed for 20 years.
No kidding.
And at the time, everybody and their mother told me, why is the sponsor fixing this? What is going on? Take a floater, take a this, take a that. And to his credit, he just wouldn't listen.
In hindsight now, like with a guy, he's seen it.
Yeah.
He was probably older than
And
He's
just
probably
knew
been
that
around. Yeah.
this rate wasn't one that was
Yeah.
going to come back around
Yeah.
very often.
Yeah.
So I
Yeah.
might as well fix this rate for 20 years and
Yeah.
Forget it.
What was the all-in rate? 3.7.
2.78.
278. Yeah.
Yeah, with 3 years of IO. So now he calls me because the IO is coming up and he's complaining. And I'm like, are you serious right now? Don't complain about your 278 rate.
Oh, sorry, your rate's going up to like 3.25.
Yeah.
You know, like all in coupon.
Yeah, no, it's still 278, just not IO. Now it's amortizing.
So, but his cash flow is going to be dinged.
Right. Yeah, nothing.
Super minor.
Yeah.
So what is your average kind of client? Like what, you were saying like average loan size is maybe like that 4 to 5 million, but like what's like the bread and butter of what are your clients buying? Like,
oh yeah. So they're buying, it's a very similar profile. It's just maybe they're executing slightly differently.
Okay.
And the profile is usually they've made money some other way, whether they've sold a business or they've owned a 20 unit apartment building and they're looking at selling, doing a 1031 exchange. And they might be looking at doing single tenant retail properties. They might look into a different asset class. They look at and they all have the same complaints. I hate the tenants and trash and toddlers and of owning. And so they're looking for something usually a little bit easier
to manage.
Okay. Yeah. And so it's probably the same profile of investors that you guys often encounter.
So a lot of times it's families or people who have sold businesses, like you were saying, that are doing this type of investment then for themselves, not necessarily for like a larger company.
Right.
Okay.
And there's varying levels of sophistication. Right.
And they might not have a big portfolio where they're going to hire a management company or somebody to help them. Exactly. Once they own this. So then all of those variables start to come into play.
For sure. Okay. Yeah. So it's a smaller private client, smaller family offices, individuals that somehow they've got some equity and they need to do something with it.
They're trying to deploy it and build their passive income stream.
Right. Exactly.
Sure.
Yeah.
What do you like right now from, so being that you've kind of transitioned your career from the film stuff, had some fun. Now you're in finance. Now you're in mortgage banking. What would you call yourself?
Mortgage banker. Okay. Yeah. It's a glorified mortgage broker.
Yeah, right. Yeah, it's way better sounding.
Yeah.
What do you like from? So our whole quest is to, from every angle, it doesn't matter what you do from a professional standpoint. What do what do we all want? It's like at some point we'd like to all live on cash flow and pay zero taxes. So what do you like from a cash flow perspective, or what, are you looking at transitioning or buying or doing anything on your own?
Yeah, I mean, I'm an investor as well. I'm an investor, an LP investor in several multifamily projects.
Okay.
As well as we're a general partner in a student housing project that we did ground up.
Cool.
But what I like is anything that has multiple tenants, right? I've got a large diversity of tenants. And so it's multi-tenant industrial, multifamily of all stripes, and multi-tenant retail. And the uglier and dirtier, the better, in my opinion, because that kind of irreplaceable real estate, or the tenants that, just really need to live somewhere or really need to have their business in a location. That's the kind of real estate that I just love. And it's honestly, I think this stuff that we've seen in our portfolio. We're a 55-year-old company. And because of the profile of the smaller deals that we've done forever, it's always been the less sexy, dirtier, smaller stuff. And that kind of business through all the cycles, now our company's 6 or 7 cycles old, is always done well. And so
cool.
We can relate to that.
Yeah, I'm biased because that's all I know, but it just seems to be truth.
But there's fruit there. You've seen it. There's a track record of data. You can go back 55, 60 years.
Exactly.
Yeah. There's a need for that type of space. I mean, we're seeing that. Mobile home parks are not sexy sometimes, that when you compare them, especially to like,
brand new class A multi.
Exactly. And so it's not, but everybody needs a place to live that's affordable. And so, it doesn't necessarily mean that because it's crusty or not sexy, that it's not a really great, nice place to live. Just like you're saying, these retail offices or places that people still have a need. Yeah. Even though they're not sexy, it doesn't mean that they're not great places. And potentially great locations, it's like.
Well, and then what I like about the old comment, like older, maybe a little bit more run down, but could be fixed up potentially.
Right.
Is the locations are going to be more urbanized.
Yeah. They've been there
because
longer.
they were there in the 1970s. So they're not out in the hills.
They're more in town.
They're in town and the town is just boomed around it.
Right.
And now it may be in a little bit of a sketchy market, but at the same time, you're not going to be paying premium Class A prices for whatever that asset is.
Yeah.
But you're in a good, strong location. You're probably not betting on some crazy, huge rent growth.
Right.
But you have a hub and a location.
Yeah, my mentality has always been as an investor, if my working class roots, family and friends would have lived, worked, worshipped, whatever in that location, then it probably is going to be solid for a long time.
Yeah.
And that's sort of the mentality that I carry around is I want to house families. I want to house people that, are just trying to make through. And, obviously my faith informs that too. But just from a safety perspective as an investor, I like multiple tenants because you're spreading out the risk.
Totally.
Yeah.
Right. I
get that. I agree with you. Yeah.
Yeah. You diversify who your tenant pool is.
Yeah. And we've had clients and seen people who buy big box 1-tenant buildings. And when that tenant leaves, man, you are in a pickle until you can find somebody to fill that space. And then there's less, demand for that sometimes, depending on how large the big box is. So we like the multi-tenant. It's way less risk. And if you lose one or two, it doesn't matter as much.
We have partners now that have basically transitioned to where they used to love triple net and there was a heyday.
Yeah.
And they were clipping 8-10% and it was good. And then it was a military contracting, like several, maybe 5 units, but big and back east. And it was good. And then it's like, half the building's leaving. And by the way, we're going to have to spend like $5 million in TIs to make it ready for the next person. So if you were to do the math on that, it's like, yeah, you clipped 8 or 9, 10%, but now you have all this cost that you're going to either have to borrow or put in out of pocket. To where if you now take the aggregate track record return, it's
well, and you might have 100 or 200 or 500 down days, right? Where you're not having any cash flow.
Exactly.
But people only remember the good.
Right.
And then until it's bad again. And then it's like, we got to get out of this.
Fire.
And then they sell it and it's a whole thing. But we like, to diversify. Like for new deals, I tell people try to get 20, 30 units plus.
Right.
And go somewhere where you can afford to buy a 20 unit versus trying to buy a high price 20 unit.
Yeah.
Just so you can diversify your, tenant base.
Yeah. Yeah. I mean, on our general partnership, it's a deal here in San Diego and it's a beautiful Class A multi-tenant building and it's full. But because we delivered when we delivered and because where the capital markets are right now, we're break-even coverage. And so we have this beautiful building I can point to. Look at that thing I built. That's amazing. But we have nothing to show for it on a day-to-day basis. It's kind of amazing, and certainly taking on something that's a little older or a little dirtier, or a little whatever, but has, tremendous cash flow and is lower leveraged and all of the other things. I'm, as a debt guy, I'm tremendously averse to debt.
Yeah. Okay, so let's wrap up with the Christian debt dynamic.
Yeah.
I had a billionaire sit me down. That's a Christian guy, friend of mine through church, actually. And he lays out in his coffee shop. He owns a ton of real estate. And we're like in his coffee shop, and then you go in this door and he's got like this like meeting room. That's his own meeting room. And he kind of lays out, he's like, okay, so you should know that, as a Christian, basically, the world and the hardware is built by God. So everything you can feel and touch is godly, is good. But the software and everything in the unseen is evil and it's corrupted, basically. And he goes, so you, and he knows my story. I've been getting to know him. It's like, so you don't ever want to cross collateralize assets and you want to work to minimize debt over the long haul and eventually pay it all off. Because at the end of the day, the debt is evil and used to control you. And like the hard assets aren't inherently evil. So like your mobile home parks, your apartments, all that, he's like, go, run. but be cautious of debt. And it just kind of like shook me, you know?
Sure. Yeah.
You know,
Well, you're kind of in this
I'm
coffee
a debt
shop,
guy,
in this back room. You're like hearing this. You're a believer, but like, what's happening here?
And I look up to this guy. I mean, he's a legit billionaire.
For sure.
And he owns all his stuff free and clear.
Yeah.
Come to find out.
Kind of
you know?
impressive. You know,
I mean,
really.
it's amazing, right?
Yeah.
Absolutely.
And I don't know the whole backstory, and who really cares? I mean, maybe there was some family money involved, maybe not. I don't know. But it was just one of those moments. So being that, you know, you and I bump into each other and we have fun with a group of guys, you know, making sure we glorify Jesus, you know, the debt thing's a little tricky.
It is. Yeah. I mean, the one thing that gives me a little bit of solace, because there's very few things that Jesus goes like, this ain't okay. And being a money changer or a debt guy is one of those things, right? He points out. So that's fun. But the other thing that I think about is, you know, the story where he goes, where they test him and he says, you know, and he asks them, give me a denarii, whose image is on this? And then he says, give unto Caesar what is Caesar's, give unto God what is God's. What I hear from that story, and I don't know if this is really what Jesus is getting at, but what I hear is that ultimately God owns all of it, including the debt, including the money.
Right.
And that money itself can be the fruit of all evil, but doesn't have to be necessarily. Mm-hmm. And so what I try to do with my data business, and I have a close believer friend that is also a divorce attorney, and he struggles with that in a different way, right?
Oh, sure.
Jesus goes, divorce ain't okay too. My parents are divorced.
That's sort of
but
like the tax collector
it's the
kind
same
of conversation.
idea,
Yeah.
right? So the point is, it's like, if I'm authentically trying to follow Jesus, that's not to say that I'm doing everything right, but I'm giving it all to him anyway. Right. And so I'm not sure if that's a cop out necessarily, but I do feel it's at least gives me permission to do this for a time.
Well, and then you're probably not actively trying to get people into debt that is going to cause them harm.
Exactly.
You know, like,
and he's
hey, maybe you shouldn't take this floating rate loan. You know, like you can assess the risk, help them through that.
And he's helping people if they get in a pickle to really kind of create that, you know, creative
Yeah, that's
solution.
the story I like to tell myself.
Yeah.
But yeah, thanks, Jen.
Yeah, it sounds great.
No, but yeah, well, okay. So you wake up, you know, you're a divorce attorney. You wake up and you're a divorce attorney and you want to believe in Christ and live out a Christian life.
Yeah.
Yeah.
You know, what does that mean?
Right.
And so I could see
Well, and
how.
ultimately, Jesus' whole thing is that the Pharisees were checking all the right boxes, but they still missed the point.
Yes.
Right. So and he dined with the tax collectors. He's dining with me, and I only deserve just that. Right. So
It's an interesting thing. I just wanted to.
Our God is so big.
Yeah.
So big.
Well, cool. Well, I really appreciate having you out. Fun time getting to know what's going on in the markets. And
thank you. It's a pleasure and an honor.
Yeah.
Appreciate it.
Thanks for coming. Hope you had a good time here.
Yes.
We'll get you in airplanes. You
Yeah.
know, eventually. You can wait for the kids to get older. But yeah, we love airplanes around here. So
Thank you.
We'll do that. It'll be fun.
That'd be awesome.
Thanks for coming,
right.
Cody.
Thanks
All right.
for coming. Nice having you.
We'll see you next time on the CashFlow Quest. Thanks for joining us.
Bye,
Cheers.
guys.